Hello, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of March 31st, 2024. Thank you very much for joining me. Despite facing numerous challenges in 2023, the U.S. economy defied widespread predictions of recession. Growth moderated to a still strong 3.2% pace in the fourth quarter, while inflation continued to fall toward the Fed's 2% target, although progress has slowed in recent months. In February, the year-over-year CPI was 3.2%, then increased to 3.5% in March. This year, moderate job gains and easing inflation should allow the U.S. economy to continue on a soft landing path. However, as cyclical tailwinds fade and the U.S. election approaches, there is still plenty of risk to economic stability. Meanwhile, while the Federal Reserve held rates steady at its March meeting, the updated dot plot showed only the smallest possible majority of FOMC members expecting as many as 3 rate cuts in 2024, and they reduced the expected rate cuts in 2025 from 4 to 3, underscoring the very gradual nature of projected policy easing. And the latest CPI data is not helping the Fed rush into rate cuts either. On a more positive note, they did express their intention to begin to reduce quantitative tightening fairly soon. As investors adjusted to the prospect of fewer rate cuts, long-term interest rates moved higher during the first quarter. Equities, however, appeared unfazed by this, setting new all-time highs, with the largest stocks still leading the charge. In the year ahead, attractive relative fundamentals outside of the largest stocks should support broader equity market performance, while fixed income should play its traditional role of providing income and diversification. In this quarter's Economic and Market Review, we assessed the performance of this past year for the markets and economy, considering trends in growth, jobs, and inflation, and how these trends are shaping the outlook for monetary policy. This is followed by comments on growth from around the globe. Finally, we considered the implications of all of this for those investing across asset classes and highlight the importance of stepping out of cash for longer-term investors, taking a balanced view toward asset allocation, and actively managing risks within portfolios. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. Join me while I discuss these topics and more, and feel free to pause the video to read the slides. The U.S. economy ended 2023 on a high note, with the fourth quarter marking the 6th consecutive quarter of growth at or above 2%. While the economy may struggle to match last year's impressive performance, 2024 looks set to be another year of expansion. Consumers have displayed impressive strength, supported by a tight labor market. That said, some signs of stress are starting to emerge. While revolving credit as a share of disposable income is not flashing any warning signs, auto and credit card loan delinquencies have risen above their pre-pandemic levels, with student loan delinquencies likely to follow. As the still tight labor market and rising real wages offset dwindling excess savings and tighter credit conditions, consumers should continue to spend at a more moderate pace this year. Business spending has endured tighter lending standards better than expected, supported by increased spending on intellectual property with greater emphasis on developing artificial intelligence capabilities. Tailwinds from AI spending and support from the federal government should continue to partially offset the impact of higher interest rates, while inventory should continue to grow at a steady pace. However, tighter lending standards and weaker corporate profits could still constrain growth in capital expenditures. The housing market is stabilized at depressed levels, and while a boom in the sector seems unlikely given elevated mortgage rates, tight supply suggests a recovery in activity is more likely than another decline. Trade may be a slight drag on the economy as a still strong dollar and sluggish global growth weigh on exports. Meanwhile, increased spending on public infrastructure and stronger hiring should continue to support government spending. Overall, the U.S. economy remains on a soft landing track, although last year's momentum looks set to fade. While the labor market has normalized from its post-pandemic boom, the U.S. economy still added an impressive 250,000 jobs per month in 2023 and has sustained this pace into early 2024. This has occurred even as the unemployment rate has remained at or below 4% since December 2022, the longest such streak of low unemployment since the late 1960s. Despite fears of an economic slowdown, strong growth in the U.S. labor supply has allowed employers to steadily hire workers and narrow the gap between supply and demand. After falling sharply during the pandemic, labor supply in the U.S. staged an impressive recovery over the last 2 years, largely due to increased immigration. In fact, in fiscal year 2023, Immigration Services approved over 2 million applications for employment authorization, a 70% increase from a record 1.2 million in fiscal 2022. With this surge in migrant workers, employers were able to fill job openings without applying upward pressure to wages, helping explain why strong job creation hasn't sparked higher inflation. Importantly, a strong recovery in the labor force participation rate has also boosted labor supply. Therefore, immigration is guiding the U.S. economy toward a soft landing. While the continued aging of baby boomers into their retirement years have left the overall labor force participation rate below pre-pandemic levels, participation amongst those aged 18 to 64 has fully recovered its pandemic losses. Moving forward, still elevated job openings and moderate economic growth point to steady job gains ahead. While this would seem to imply a steady decline in the unemployment rate, the continued influx of migrants should provide a fresh source of workers, which could keep the unemployment rate within a narrow range of 3.5 to 4%. We just looked at labor supply. Now let's take a quick look at labor demand. On the left side, you can see that job openings have been declining. However, it's still well above pre-pandemic levels. Combined with low unemployment, this makes for a tight labor market. Job quits have returned to pre-pandemic levels after the Great Resignation of 2021. It has been declining, yet it's less steep than in the pandemic as workers are more reluctant to quit. Finally, job layoffs have remained near record lows for the last few years. These labor market statistics help explain why it can be difficult for an unemployed person to find work in this job market. While year-over-year CPI inflation remains well below its June 2022 peak of 9.1%, it has stubbornly hovered around 3.2% since October, sparking fears of no further meaningful decline. However, we believe that there are still disinflationary forces that should keep inflation on its downward path this year, despite the March increase. Core goods prices trended lower in 2023 as supply chain distortions related to the pandemic and Russia's invasion of Ukraine continued to fade. Even with recent conflict in the Middle East, supply chains are still in good shape and good prices should remain well behaved. On the more volatile components, energy prices have risen in recent months while food prices continue to ease. Moving forward, slow global demand limits the likelihood of a surge in either of these categories. Lastly, shelter inflation, which accounts for over a third of the CPI basket, should follow real-time measures of market rent increases. That leaves us with core services prices excluding housing, a closely watched measure by the Fed given its ties to the labor market. As shown on the right-hand side, progress here has stalled in recent months, largely due to transportation services, which remains elevated due to things like auto insurance and repair costs. However, pressures here should ease substantially. This, along with moderating wage growth, should allow services prices to trend lower through the end of the year. Overall, the disinflationary trend established in 2023 should continue into 2024. While the ride down may take slightly longer than expected, the Fed should feel reasonably confident that inflation can fall close to their 2% target by the end of the year. With the fourth quarter earnings season in the book, earnings growth finished 2023 flat despite a year of above average economic activity. While these are seemingly lackluster results, they actually surpass initial expectations for a small earnings contraction. Robust economic activity supported revenues, which were the largest contributor to earnings growth, as consumer strength and pricing power helped boost sales. Margins, however, have detracted from earnings as higher wages, inflation and input costs, and geopolitical turmoil offset some of the cost savings of adapting more efficient technological processes. This dynamic was evident in the fourth quarter as margins fell after a third quarter recovery. While profits could experience healthy growth in 2024, downside risks to analyst expectations for double-digit earnings growth remain. Indeed, gloomy commentary from management teams point to tougher times ahead as growing revenues will become increasingly difficult in an environment of moderating consumer demand and disinflation. However, after the Magnificent Seven companies drove the lion's share of earnings growth in 2023, profit leadership should broaden out this year. The companies of the Mag 7 include Microsoft, Apple, NVIDIA, Amazon, Meta, Alphabet, and Tesla. Late last year, the Federal Reserve sparked investor enthusiasm for aggressive policy easing in 2024 after they signaled that rates are at their cycle peak. Since then, mixed economic data has challenged investors' outlook for rate cuts and left them searching for more guidance. At its March meeting, the Federal Reserve left rates unchanged at a range of 5.25% to 5.5% and continued to signal 3 rate cuts in 2024. In addition, they increased their projection for the federal funds rate in the long run from 2.5% to 2.6% in a sign of a slightly more hawkish stance. In addition to rate cuts, the Federal Reserve signaled that they plan to slow the pace of quantitative tightening fairly soon. This should leave the Fed with much larger Treasury holdings than before the pandemic for an extended period of time, helping hold long-term interest rates down. With market expectations and Fed messaging very much in sync, it would likely take a meaningful change in the economic outlook to trigger any sharp movement in long-term interest rates in the months ahead. The international economy ended 2023 on a rather sluggish note, although there were some exceptions. This dynamic will likely persist into 2024 as some economies could outshine others amidst slowing global momentum. Depressed sentiment in China continues to challenge both domestic and global growth, and even more economic troubles could lie ahead without meaningful policy support for consumers and manufacturers. Similarly, Europe remains burdened by weaker consumption and business activity, particularly in Germany. However, the prospects of lower energy prices and rising real wages have sparked optimism for improvements ahead. In Japan, the end of negative interest rates should serve as a strong tailwind for activity after the country narrowly avoided a technical recession last year. Other markets such as Mexico, India, and Taiwan have benefited from positive secular trends, including supply chain diversification and semiconductor manufacturing related to AI. This year could bring better performance for places like Japan and some European markets, while others like China may continue to struggle. With U.S. consumer activity expected to slow, there is still potential for growth differentials to narrow and for other global markets to surprise to the upside. After hopes for aggressive policy easing fueled an impressive bond market rally late last year, most sectors shown on this slide are off to a slower start in 2024 as resilient economic data have forced investors to rein in their expectations for rate cuts. That said, with market and Fed expectations now largely in line, the worst of bond market volatility is likely behind us, and current yields appear increasingly attractive. Indeed, with higher yields now offering an attractive yield cushion, fixed income offers strong asymmetric returns. Taking the U.S. aggregate as an example, if interest rates were to fall by 1%, an investor could expect a return upwards of 11%. However, if rates were to rise by 1%, that same investor could expect a loss of only 1.5%. While rising interest rates led to negative bond returns in 2022, those higher rates today offer investors both positive real income and the portfolio protection provided by the traditional tendency of bonds to rally when stocks falter in the face of economic weakness. After an impressive 2023, U.S. equities have continued their upward momentum in the early months of 2024. In fact, resilient corporate profits and hope for policy easing have produced multiple all-time market highs this year. However, market performance remains concentrated as the largest stocks in the index have continued to dominate. While valuations may look stretched, there are still plenty of attractive opportunities outside of this cohort of mega-cap stocks. On the left, we compare the price-to-earnings ratio of the top 10 stocks in the S&P 500 to that of the broader index. The historically narrow nature of the recent rally has left the top 10 stocks significantly more expensive than the broader index, while the remaining stocks look cheap comparatively and are trading closer to their long-term average. These 10 companies are Microsoft, Apple, NVIDIA, Amazon, Meta, Google, Eli Lilly, Broadcom, the chip manufacturer, and JP Morgan, whose very chart we are looking at right now. While many U.S.-based investors may feel inclined to focus on opportunities at home, there are attractive fundamental tailwinds emerging outside of the U.S. that can't be ignored. This slide aims to highlight opportunities that investors may be missing. In terms of earnings growth, the U.S. has been the standout market as of late, although prospects in other countries are improving. In particular, higher inflation in Japan and Europe has allowed companies to raise prices and expand their margins, and the end of negative interest rates in both places should help boost profits for financials, a key sector in both markets. While pessimism around China has weighed on emerging markets' earnings estimates, they have stabilized in recent months, suggesting that the worst of this pessimism is already priced in. With the exception of China, strong equity returns since the beginning of 2023 have pushed valuations higher. Even still, international markets continue to look attractively priced compared to the U.S. Overall, the potential shift in earnings growth across international markets, combined with discounted valuations, presents an attractive opportunity for U.S. investors looking to diversify abroad. Thanks to the Federal Reserve's rate hiking campaign, cash looks more attractive today than in the last 2 decades. With yields north of 5% and minimal risk, many investors have decided to allocate more heavily to cash, pushing money market fund assets to a record $6.1 trillion. However, history shows that staying parked in cash after the peak in interest rate usually leaves money on the table. In the last 6 rate hiking cycles, the U.S. aggregate bond index outperformed over cash in each of the 12-month periods following the peak in CD rates, while the S&P 500 and the 60/40 stock bond portfolio outperformed in 5 of these periods. This is not to say that investors should abandon cash altogether, as liquidity is an important allocation in any portfolio. However, there is an opportunity cost in holding on to too much cash, and investors should put long-term money in long-term assets. Following a peak in interest rates, there has always been a better asset than cash to deploy capital. This remains the case today as the U.S. and global economies continue to grow, even as inflation wanes and central banks begin to back off from very tight monetary policy. However, with the higher valuations produced by the strong investment returns of 2023 and early 2024, it is more important than ever that investors maintain well-diversified portfolios designed to reduce risk as well as provide solid long-term income and capital gains. This slide presents a comprehensive overview of the consumer balance sheet, detailing both assets and liabilities. Let's break it down. Our assets are made up of homes, including primary residences and other real estate, other tangibles like vehicles, jewelry, or collectibles, bank deposits, which are monies held in savings or checking accounts and brokerage accounts, and retirement funds, most commonly 401ks and IRAs. Our liabilities are made up of predominantly mortgages, comprising 66%. This represents the significant portion of household wealth tied up in real estate. And the remaining 34% is made up of other non-revolving credit, as in loans with a fixed term and rate like student debt, revolving credit, which is credit card, auto loans, and other liabilities, which are debts not covered in the previous categories. This slide notes a significant decrease in this ratio during the pandemic attributed to government stimulus payments. However, it has now returned to pre-pandemic levels, indicating a stabilization of household debt burdens. We see a couple of trends here. First, the debt service ratio. This measures the proportion of disposable income that goes toward paying debts. The slide notes a significant decrease in this ratio during the pandemic attributed to government stimulus payments. However, it has now returned to pre-pandemic levels, indicating a stabilization of household debt burdens. Secondly, this slide highlights increases in delinquencies for auto loans and credit cards. This uptick is associated with the Federal Reserve's interest rate hikes, which begin in March of 2022. Higher interest rates can increase the cost of borrowing, potentially leading to difficulties for some consumers in making timely payments on their debts. With 2024 being an election year, it's an appropriate reminder to not let politics affect your decisions of whether or not to stay invested in the market. This chart shows consumer confidence by political association rated as excellent or good. During the Obama era, Republicans did not feel positive about economic conditions, with only 5 to 20% ranking the economy as good or excellent. By contrast, Democrats felt more positive, with 5 to 45% higher ratings. During this period, the market had an average annual return of 16.3%. However, in the Trump era, Republican sentiment outweighed Democrats, while the market returned 16% annually on average. This pattern is really strong, so be careful to not let politics affect your investment strategy. Here's another chart that looks at the economy in years of Republican rule, Democratic rule, and divided government, years in which no one party controlled both the executive and legislative branches of government. The top chart shows annual real GDP growth, and the bottom chart shows calendar returns for the S&P 500. Most of the time, the U.S. had a divided government, shown in gray. Under all three scenarios, the U.S. has seen strong economic growth and market performance. There is no strong pattern of any combination of political rule that can predict the future of the economy. So as this election year progresses, investors would be advised to not tie a political party to economic performance. As we wrap up this quarter's review, let's examine the matrix as of March 31st, 2024. U.S. large-cap equities once again demonstrated their resilience, achieving a robust year-to-date return of 10.6%. This performance continues to lead the pack, much like last year, followed closely by developed market equities with a return of 5.8%. Small-cap equities at 5.2% return, while the traditional 60-40 stock bond portfolio returned 4.2%. However, not all asset classes fared as well. Fixed income and real estate struggled to maintain positive momentum, posting negative returns year to date. This underscores the importance of a diversified portfolio, as these two asset classes serve as a reminder that risk management and strategic asset allocation are crucial in navigating the ever-changing financial landscape. And there you have it, this quarter's economic and market review. Thank you very much for making it all the way through this quarter's video. As always, please feel free to reach out to me to review this and more.